trade gap downs. I stayed up late last night researching this on an individual trading system basis as well as a portfolio level basis. I'm going to show you what some of the things I've found so far. And this is the Cobra III trading system, 1 minute chart. And there are several options here that you can do. You can say, one, don't trade shorts. DTS, don't trade shorts. Number 2, don't trade shorts on a gap down. Don't trade shorts on a gap down. And you could say, don't trade on a gap down. So these are some of the things we're going to look at. We're going to look at don't trading the shorts, don't trading the shorts on a gap down, and don't trade at all on a gap down. So in this case, you would trade long only if the market opened higher than the previous day's close, even if it's one tick. And so I am going to show you the results of this. This is Cobra III based on its original, just using the original set of rules. Let's look at the stats for this. 78.70 over the last 3 years. This is with slippage and commission. 192.58. $11,645 drawdown. 608. And so let's take a look now at the first thing I want to look at is the number 2 scenario. Don't trade shorts on a gap down. And so I'm going to add this rule to the code. And open D is greater than the closed D of 1. When you add the D, that's the day session. So it's looking at the day session open greater than the day session close. Not just the open and close of the current bar, but the D makes it a session scenario. So I'm adding one simple rule, and we're going to take a look at what that does to the results. Now, this is what we're looking at. Remember this. I have it marked down as well. I'm going to verify the update in the strategy, and then we're going to see the performance summary updated. So I'm not showing you the rest of the code. This is a proprietary trading system, and I am updating it right now. So I've updated this. We've gone from 718.20 actually we're at 608 up to 718. The worst case drawdown is reduced from 645 to 75.75. This is over the last 3 years. 220 average trade profit, up about $28. And here is the equity curve. Nice equity curve improvement in the equity curve. What if we don't trade shorts? So I'm going to comment it out, and so we don't trade shorts at all in this strategy. And I'm going to update that. I'm going to pause the video and show you the results. So here are the results, even further improvement. The total net profit goes down because you're trading less. It's about $6,000 less, but in this scenario, the shorts have only made $6,000 while the longs have made $48,000. So $237 average trade profit. The max drawdown is $58.75. And this number goes to 833. We've gone from 608 to 718 to 833 over the last few years. And so let's now take a look at adding this rule to the longs. And so this would say we only trade Cobra III long only if it gaps up. And this is just a basic open is greater than the close. So it could be greater as long as it's greater than 0. And so if it opens up 0.1 higher, or 0.25, because the NASDAQ ticks in 0.25. So if the NASDAQ opens 0.25 higher than the previous day's close, then it would take this trade on long only on Cobra III. I'm going to pause the video, update the code, and see the results. So an even further improvement, 1,055 up from the 800% area, 276. This only goes down by 1,000. The equity curve is amazing. This is going back 3 years. The problem I have with this is the bias. We are taking long only trades on gap ups, long only on gap up, LOGU, I guess you could say. a new acronym, LOGU, long only, gap up, amazing looking equity curve, much improved performance. The problem I have is that there are cycles in the market. And so what happens if you just focus on what's working right now, that could go down, and everything that goes works better on gap downs. What if all of a sudden everything works better on gaps downs? And this cycle might be completely out of sync. It might be completely this cycle. And so while you jump on this cycle right here, and you get out of this cycle right here, this cycle goes down and this cycle goes up. And so you could do that in the short term, and you could say, you know what, I'm going to do this, I'm going to trade it like this, but I'm not. When QT really kicks in, then I'll jump back. And so there could be a lagging factor. QT could kick in, you don't know it right away, and then it could make this could do really bad, and then the original strategy could have done really well. And so there could be a difference there because there is such a bias with QE and QT. If you don't know what I'm talking about, Fed's balance sheet, interest rates, bias the market to extreme long only. Let's look at this going back further. I haven't done this yet, and so I am doing this in real time. I am curious, what does this look back 7 years or more? So that's what I'm going to do now, and then we're going to see what the difference is between a further back test, not just the last few years, because the last few years is around August of 2019. So this really just captures the main part of massive stimulus that started in March. Massive stimulus started right here, so certainly alongside bias, and it continues to be easy money policy right now. Even though the Fed started to tighten, the amount of tightening is so small that it's still easy money, really. And so let's look at a longer back test. So I loaded 7 years of data, but it did not. But the performance summary did not update. And so sometimes you have to do this: data, edit symbol. You have to do it again. Do it twice so it reloads. So I'm going to pause the video while it loads. So wow, I am impressed. Long only, going back 7 years. Keep in mind that we've had QE since 2009. So this is probably going to look good prior to this as well. I'll take a look. Amazing results. Really low drawdown. Really low drawdown. You trade if it gap up, long only. Massive bias in the system. And so let's take another look. Let's go back 12 years. So very interesting. The drawdown still stays less than $5,000. Going back 12 years to 2010. Beginning of QE. $122 average trade profit, and our original setup had $192. But you have to consider, I mean, this is with slippage and commission. You also have to consider that during this time frame, the average trade profit is lower because the index values are smaller, the daily dollar ranges are smaller, and so this average trade profit accelerates at higher index levels, and so it brings the average down when you test it back to other time periods. And so you see that here, 71, 670. You don't get a lot of performance in here with these current parameters, but it doesn't do terrible. The thing is it's still going up slowly, even at lower index levels, and it's built for current index levels basically. And so really good results. Now the thing we can do now is to pause the video, go back to the original settings, and compare it with this right here longer term. So coming back several hours later to test this, you can see the results are not as good. One of the things you have here is the short side is not profitable over a 12-year period. Now, QE started in 2009. QE is easy money policy, which has helped the stock market gradually rise and favored the long side in a biased way. And so you could remove the shorts and then turn them back on when you think QT is causing the market to go down. this gives you the option of, we're trading the long side, we have short trades going, but the short side is not hurting us too bad. And then if the market crashes, we'll all of a sudden have a strategy that takes short trades as well. So that is one thing to consider. To bias your system long only, be sure you know that those cycles can come back, and all long trades may not work for a while, and all short trades may not work for a while, or gap downs may work while gap ups do not. And so it's a pretty incredible bias, and it has been the trend, and sometimes the trend is your friend. And so that can be the $1,000,000 question, is to how much do you bias your system in this way. And so that is some data today. No conclusions yet on what to do with this in real trading for our portfolio. We're keeping it like this right now. I have some more research to do before I would make any sort of conclusions like this. We are coming into QT, and so I do anticipate that the Fed could follow through, should follow through. They may not, and we may be QE infinity. Go back to QE infinity. They may forget about inflation and just go to QE infinity. So that is the research that I wanted to share on this. I have more research related to this as well on a portfolio level and other individual trading systems. You have to consider the type of strategy you're looking at, whether it is a breakout strategy, if it buys the dips. And so when you do this bias, you have to consider those things as well. So that is what I wanted to share with you on August 18th, 2022.
Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.